Three things just happened. Silver broke a level most analysts said would cap the rally for months. Open interest expanded, not contracted, into strength. And deep out-of-the-money call options lit up across multiple expirations within 48 hours. That combination is not normal. It's not retail excitement. It's positioning stress. And while financial media is debating whether this is just another commodity spike, they are missing the structural shift forming underneath the surface. Because this isn't about a price breakout. It's about imbalance. Over the last two trading sessions, silver did something that historically only happens in the early stages of a convex move. It absorbed selling pressure without a volatility spike. That tells you something critical. Supply at these levels is thinner than the screen suggests. At the same time, Treasury yields pushed higher, which normally pressures precious metals. Silver didn't collapse. It consolidated. That divergence matters. Then the options data came in. Large call blocks above current price strikes that imply a move most traders consider unrealistic in the near term were accumulated aggressively. Not weekly speculation. Strategic positioning. Meanwhile, registered inventories remain a fraction of total futures exposure. Paper claims continue to dwarf physical deliverable supply. That ratio has always existed, but it only matters when confidence shifts. And confidence shifts quietly before it breaks loudly. Here's what most participants are missing. Short squeezes don't begin when price is already vertical. They begin when the majority believes resistance will hold. They begin when carry trades look comfortable. They begin when hedges are layered in assuming stability. That's the environment right now. Policy remains restrictive but fragile. Fiscal deficits are expanding. Industrial silver demand from solar and electrification continues to rise structurally. And speculative positioning is leaning in one direction. If even one of those pillars moves unexpectedly, liquidity injection, real rate compression, delivery stress leverage in the system does the rest. Silver doesn't require trillions in inflows to move dramatically. It requires marginal imbalance. And because the silver market is small relative to global capital pools, the adjustment mechanism is violent when it occurs. By the end of this video, you're going to understand why the current macro environment resembles previous pre-squeeze setups. Why miner earnings are quietly signaling something the futures market isn't pricing. Why physical tightness doesn't need to be extreme to trigger stress. And how the options complex can mechanically force price far beyond what fundamentals alone would justify. This is not about hype targets. It's about structure. It's about leverage. And it's about understanding when the market is misaligned with its own positioning. Let me show you why. Let's start with policy. Because silver doesn't move in isolation. It moves inside liquidity cycles. Over the last several quarters, monetary authorities maintained restrictive policy to contain inflation. Real rates turned positive. Balance sheets contracted. Financial conditions tightened. Historically, that environment suppresses precious metals. But here's what changed. Fiscal deficits remain structurally elevated. Government issuance of sovereign debt continues at a pace that requires constant absorption by the market. When bond supply expands faster than natural demand, yields must rise to compensate. Higher yields tighten financial conditions. Tighter financial conditions slow growth. Slower growth pressures credit markets. And here is the inflection point. When tightening policy begins to destabilize financial plumbing, central banks are forced to adjust tone, if not immediately adjust policy. Markets do not wait for official easing. They price the pivot. Silver historically responds during the anticipation phase of liquidity shifts, not after confirmation. In prior cycles, the largest silver rallies occurred when real yields peaked and began compressing. Fiscal deficits remained wide. Growth uncertainty increased. Policy credibility was questioned. We are approaching that configuration again. Another layer. Global energy transition policy mandates are increasing silver's structural industrial demand. Solar installations, grid infrastructure, EV expansion. These are not cyclical whims. They are multi-decade commitments. That creates a baseline demand floor independent of monetary flows. Now overlay monetary fragility with structural industrial demand. That's a different setup than prior cycles. Policy is restrictive, but the system cannot tolerate restrictive policy indefinitely. Silver does not need easing. It needs anticipation of easing. That shift begins quietly, and markets are beginning to whisper it. Corporate earnings/miner signal. Now, let's move to the miners. Because miners often telegraph what futures traders ignore. Recent quarterly reports from major silver producers show something subtle but important. Margin expansion ahead of explosive spot price moves. Average realized prices in the last quarter were modestly above benchmark averages, not dramatically higher. Yet free cash flow improved disproportionately. Two explanations exist. First possibility: operational efficiency improved dramatically. Cost controls tightened. Energy inputs moderated. Productivity increased. Second possibility: forward contracts and negotiated supply agreements locked in stronger pricing than the visible spot market suggested. Which explanation is more likely? Operational improvements happen gradually, but sudden margin flexion during moderate price increases often indicates forward strength. Producers frequently see tighter physical bidding before futures markets fully reprice. Another important detail: capital expenditure discipline remains high. After years of underinvestment and project delays, there is limited new primary silver supply scheduled to enter production in the near term. Global mine production historically grows at low single-digit rates annually. Industrial demand growth, however, has accelerated faster than mine supply growth. That imbalance doesn't immediately explode price. It builds tension. Miners today are not expanding aggressively. They are optimizing. That behavior is defensive and bullish. When producers hesitate to overspend into rising prices, they constrain supply elasticity, which means if demand spikes unexpectedly, there is no rapid supply response. That is squeeze fuel. Physical market evidence. Now step outside future screens. Look at the real world. Retail dealer inventories have not collapsed, but premiums remain sticky relative to historical norms during quiet periods. That tells you physical buyers are still active. Industrial buyers, particularly in solar manufacturing, continue securing forward inventory. Silver consumption in photovoltaic applications has grown consistently over the last several years. Even marginal growth at scale matters. Silver is consumed. Unlike gold, much of it is not easily recycled in real time. Another layer. Shipping timelines for large wholesale bars have shown periodic delays in certain global hubs. Not crisis level, but friction exists. Now, consider exchange inventory data. Registered inventories represent metal available for immediate delivery against futures contracts. Open interest in silver futures often represents multiples of that deliverable supply. That is normal in derivatives markets. But during periods of rising volatility, that leverage becomes relevant. You do not need every contract holder to demand delivery. You need a small percentage shift in behavior. If 3 to 5% of open interest stands for delivery beyond historical norms, registered inventory tightens quickly. That forces cash settlement incentives, roll pressure, spot futures divergence. International pricing divergence also occasionally appears during stress. When overseas physical demand strengthens faster than futures markets adjust, local premiums rise. This is how physical signals precede paper repricing. We are not in a shortage panic. We are in a tightening phase. And tightening phases precede price repricing events, not follow them. Derivatives/futures/options pressure. Now we reach the mechanical core. This is where short squeezes are born. Silver futures markets allow significant leverage. Open interest frequently represents hundreds of millions, even billions, of ounces in notional exposure. Registered warehouse inventories are a fraction of that. Again, that is standard. But leverage matters when volatility rises. Now add options positioning. Recent data shows increasing call open interest at strikes significantly above current spot levels. Why does this matter? Because market makers who sell those calls must hedge directional exposure. As silver price approaches those strike levels, dealers buy futures to remain delta neutral. As price moves further, hedging accelerates. This is gamma exposure. If price crosses heavily concentrated strike levels, dealer hedging can become self-reinforcing. Combine that with systematic trend-following funds adding longs, short sellers hitting stop losses, momentum traders entering breakouts. You create positive feedback. Is this guaranteed? No. But is it structurally possible? Absolutely. Now, consider short positioning. If speculative funds built short exposure, assuming resistance would hold, and price breaks decisively above that resistance, covering begins. Short covering is not discretionary buying. It is forced buying. Forced buying into thin markets creates vertical moves. That's the anatomy. It's not conspiracy. It's math. Convergence, the unified macro thesis, now connect everything. Policy is restrictive but fragile. Fiscal dynamics increase long-term currency debasement risk. Industrial demand provides a structural floor. Miners are not expanding supply aggressively. Physical markets show tightening, not abundance. Futures leverage remains high. Options positioning introduces convexity. This is how nonlinear price behavior forms. Silver is not a trillion-dollar deep liquidity market like major equities. It is smaller. That makes it sensitive to marginal capital flows. If institutional allocation shifts, even modestly toward hard assets, as insurance against policy error, silver can reprice faster than gold. Because gold is a central bank asset. Silver is a hybrid asset, monetary plus industrial. That hybrid nature creates dual demand vectors. Most participants anchor to prior resistance levels. They assume mean reversion. They assume rallies fade. But markets transition when consensus confidence is strongest. If real yields begin compressing, if volatility in other asset classes rises, if liquidity injections quietly resume, if delivery demand inches higher, the adjustment does not happen slowly. It cascades. And that's the key word, cascade. Not because of emotion, but because of leverage meeting scarcity. Silver does not need a narrative explosion to move toward extreme price levels. It needs positioning misalignment. And that misalignment is building. The question is not whether silver can reach $80 or $100. The question is what combination of catalysts would make that outcome mechanically possible. And today, the ingredients exist. They are not fully activated, but they are present. That is the difference between hype and structure. Let's compress everything we just mapped. For signals stand out. Policy tension. Monetary conditions remain restrictive, but fiscal expansion continues. Sovereign issuance is high. Financial conditions are tight but fragile. History shows that this phase late cycle restriction under fiscal stress is when markets begin front-running liquidity shifts. Silver doesn't wait for rate cuts. It responds to real yield compression and credibility risk. Miner behavior. Margins are improving without aggressive expansion. Capital discipline remains intact. There is no flood of new supply rushing online. That tells you producers are not betting on temporary spikes. They're managing scarcity. Physical market firmness. Not panic. Not shortages. But steady demand. Sticky premiums. Industrial buyers securing supply. Inventories that look sufficient until behavior changes. And behavior only needs to change slightly. Derivatives asymmetry. Open interest remains elevated relative to deliverable supply. Call positioning is clustering above current price. Short exposure exists in size. In quiet markets, leverage is invisible. In volatile markets, leverage dictates direction. Now put these together. Policy fragility, supply discipline, physical tightening, options convexity. That's not noise. That's structure. What does this mean for the next 6 to 24 months? It means silver is entering a zone of asymmetric outcomes. Downside remains possible. A sustained rise in real yields could delay upside. A sharp global slowdown could weaken industrial demand temporarily. A stronger dollar could pressure speculative flows. Those are real risks. But the upside scenario is nonlinear. If real yields compress meaningfully, if liquidity re-enters the system even modestly, if risk markets wobble and capital seeks hard asset insurance, if delivery behavior shifts just a few percentage points, silver doesn't grind higher. It reprices. That repricing is not emotional. It's mechanical. And mechanical moves are the ones that catch markets off guard. Now, let's address the uncomfortable part. Could silver fail here? Yes. If policy remains restrictive longer than markets expect. If inflation collapses without financial stress. If industrial demand slows sharply. If speculative positioning unwinds before a catalyst emerges. Markets are probability engines, not guarantees. But here's what matters. The setup today is not random. It's layered. We are seeing early signs of structural stress, not collapse inside a leverage system. Silver's market size is small relative to global capital pools. It does not take massive allocation shifts to produce outsized price reactions. Most investors anchor to past resistance levels. They assume what failed before will fail again. But markets transition when the underlying structure changes. And structure is changing. The difference between a normal rally and a squeeze is not price level. It's positioning. Right now, positioning assumes stability. It assumes resistance will hold. It assumes carry remains safe. Those assumptions work until they don't. Over the next 2 years, the macro backdrop is unlikely to be simple. Debt levels are elevated. Geopolitical tensions remain present. Industrial transformation continues. Monetary credibility is being tested globally. In that environment, hard assets re-enter portfolios not because of fear, but because of strategic allocation. Silver sits at the intersection of monetary hedge, industrial input, speculative vehicle. That combination creates volatility, but it also creates opportunity. The responsible approach is not chasing headlines. It is tracking real yields, liquidity measures, inventory data, options concentration, delivery trends. If those variables begin aligning simultaneously, you will not need someone to tell you a squeeze is forming. Price behavior will confirm it, and by then, the narrative will follow. The market rarely announces structural shifts in advance. It signals them quietly, through divergences, through margin expansion, through subtle positioning changes, through resilience when it should be weak. That resilience is often the first clue. The biggest mistake investors make is assuming tomorrow will behave like yesterday. But when leverage builds under the surface, yesterday's logic stops applying. Silver may not go to $80. It may not go to $100. But the probability of an outsized move has increased. Not because of hype, not because of social media excitement, but because the ingredients for convexity are present. And convexity is what defines major market moves. So the real question isn't, will silver squeeze? The real question is, if it does, will you understand why? Or will you think it came out of nowhere? Markets don't move randomly. They move when structure demands adjustment. Right now, silver structure is tightening. Stay analytical. Stay independent. Stay observant. Because if the biggest short squeeze nobody anticipates begins to unfold, it won't start with a headline. It will start with pressure. And pressure, when ignored long enough, releases all at once.